Are you moving to the US, or possibly you already live here and you're trying to understand what the US tax implications are? This video is for you. So what we're going to talk about is, what are the things you need to look out for when you're looking to move to the US? When are you considered a tax resident of the US? How does that affect the country you came from? And what are the dates you need to be worrying about? So that's what we're going to talk about in this video. I work with a lot of people that move to the US, especially from Canada, but really from anywhere outside the US, that own assets outside. And we want to make sure that you're being taxed efficiently on those assets and that you're getting the best treatment overall from a tax perspective. So the first thing we look at when somebody's looking to immigrate to the US or come here is, what is going to be their tax residency start date here in the US? So once you become a tax resident of the US, you're taxable on your worldwide income. And not only that, you have to report your worldwide financial assets to the IRS. Tell them about things like bank accounts, financial accounts, pension accounts, and also ownership of foreign companies outside the US, which has all kinds of tax implications associated with it. So that tax residency start date is critical. And it also has to connect with the tax residency end date in the country you're coming from, especially if that's a taxable country. So in the US, we have 3 ways of determining if and when you are a tax resident. One is if you're a citizen, another is if you're a green card holder, but mainly what we're focused on here is the substantial presence test. So the substantial presence test starts with a 183-day test. So if you have more than 183 days in the US, you will meet the substantial presence test and be taxable as a resident as of the first day you're here in the US on that date. But the 183-day test, the IRS goes one step further to further complicate an already complicated rule, to say that they don't just count the current year days in coming up with that 183-day test. They look at the total days in the current year, 1/3 of the days in the year prior to that, and 1/6 of the days in the year prior to that. So that's one big thing to make sure that you're aware of, is you don't just do a straight 183-day count to see if you're a resident or not. So for example, if you moved to the US in 2024, we would count your days in 24, 1/3 of your days in 23, and 1/6 of your days in 22, add it all together. And if it's over 183, then the first day you're in the US in 2024 is your date of residency, tax residency in the US. And that's when your worldwide income starts, basically. There's some nuance to that. You know, if you had some trips under 10 days prior to that residency date, it could get carved out. But generally, that's the rule. So let's say you moved in, let's say June of 2024. So even without the prior days, you're going to meet the 183-day test. So we know that's your residency start date. So what that means is you're going to have a dual status return for that first year. So if you're married and you both moved together, you cannot file a joint return in the US if it's a dual status return. Dual status meaning the first part of the year is non-resident, the second part of the year is resident. So you're going to have both a 1040 and a 1040NR on the same return, and you have to file separately. In the residency period, we're picking up worldwide income, we're reporting foreign financial assets. In the non-residency period, we're only picking up your US source income. That's the basic rule. So the next step is there a better option for us than that? Maybe it's better to be a resident for the full year so that you can file jointly. Filing jointly has 2 benefits. One, you can take the standard deduction, which filing jointly is over $20,000. As a dual resident return, there is no standard deduction. And secondly, your marginal rate basically gets cut in half with the married filing joint rates. So we would look at that analysis. And so what I do with a lot of my clients is I actually run that calculation to see what's better, filing as a full year resident or not. The downside, obviously, of filing as a full year resident is you're picking up all that worldwide income prior to moving to the US. It may not matter though, because you're going to get a foreign tax credit. So if you're moving from a taxable country, we're going to get a credit for the taxes you paid on that foreign source income. So it may not have a tax difference, but at the end of the day, you just have to run the numbers and figure out what is the best option for you. The other thing you want to look at is, what are you leaving behind, right? So when you come to the US, we'll figure out what's the best tax residency start date for you, but also we want to look at your assets that are outside the US and how they're going to be treated going forward once you're a US tax resident. So With foreign companies, for example, let's say you have an operating company outside the US and it's set up as a foreign version of an LLC. If you move and become a US tax resident, it's going to be considered a controlled foreign corporation. And there's all kinds of nuance and complication with controlled foreign corporations that may not be in your best interest from a tax perspective. On top of that, you're going to carry over the basis in that asset. So especially if you were thinking about selling that foreign company or that foreign asset, you're going to have the same basis, same built-in gain on it after you've moved as you did before. One of the more typical planning opportunities we do, especially for foreign companies, is make what's called a check the box election or an entity classification election for that company prior to moving. So what you can do is, if we know your residency start date is, say, like we mentioned before, June 1st of 2024, we could make an election to treat that foreign company as a flow-through or a disregarded entity as of your residency start date, which would be June 1st. What that rule does is it triggers a deemed sale of that asset the day before the effective date. So the day before your residency date. The day before, you have a foreign person owning a foreign asset. There's no US tax reporting, no US tax on that sale. So it has no impact on your US tax return whatsoever. And it's not a real sale, so it's not like the foreign country is doing anything about it. The benefit of that is that now it's giving you a step up in basis. It is a deemed sale from the IRS's perspective, but there's no tax on it, but you've gotten a step up in basis. So let's say that that asset is worth $200,000 and you purchased it, or maybe you even started the company a long time ago for $10,000. Now you've gotten a step up in basis in the US on that asset. So if you were to sell it later, your basis is now $200,000 and not the $10,000. That's a huge benefit that you'd be missing out on if you didn't make that check the box election in advance. Of course, we have to look at how the foreign country would tax a certain sale, so it may not make a difference if the foreign country is taxing it too, but a lot of countries aren't going to continue to tax that sort of income. So we just have to look at it and see what makes sense. Another thing to look at is, other assets that come into play are foreign trusts. How would the IRS look at different foreign trust situations and investment accounts? Are you getting into a PFIC situation where foreign mutual funds come into play? So there's all kinds of things we want to look at prior to. And I think that's the main point with immigration planning to the US, is that once you've crossed that date of residency, there's not a whole lot you can do from a planning perspective. Then we're just playing defense, right? We're just trying to figure out how can we file the right forms and limit the tax as much as possible, as opposed to being able to proactively limit tax or make a more efficient overall global effective tax rate. So if you're looking at moving to the US, make sure to reach out to someone in the US that has experience with immigration planning, with tax planning for non-residents moving here, so that you don't miss out on a particular tax benefit that wouldn't be that complicated to do. You just don't know what you don't know until you've talked to the right person. If you have questions about moving to the US or tax planning associated with that, reach out to us at mcgowantax.com and schedule a call with me personally.